Hey everyone, Mark Ferguson with Invest for More, and welcome to another one of my investing videos. Today I'm going to talk about rental properties. Haven't talked about them for a while, haven't bought any for a while, that's part of it, but I do have a new one this year and hopefully some more new ones coming up that I'll be able to share with you soon. But today I'm going to talk about how much money you need to buy a rental. So there's ways to buy as an investor, owner-occupant, and all types of different ways in between to buy with more money and less money. We'll go all over that. In the meantime, make sure you check out investformore.com. Lots of information on my properties, my flips, my rentals, on my real estate team. And I think I have 400 some free articles on there right now. And I've got my weekly podcast too. So I've always got cool guests on there. And sometimes I'm just talking about what's going on in my world. So let's get started. Rental properties. They are one of my favorite ways to invest in real estate. Even though my main focus right now is flipping, I have 16 flips going at the moment. My goal is to flip 30 houses in 2017. Flipping is more of a job. It's not an investment for the future because once I sell that house, I have no more money coming in from it. So it's a great source of income, but you're not really investing when you flip. So it's a lot of fun. I love doing it. I'm kind of addicted to buying houses. But for investing, I love rental properties because once you buy a rental, and as long as you keep it, it's going to keep bringing in money every month. And eventually you'll pay off the mortgage. Rents will go up with inflation, so it's a natural hedge against inflation. Plus they have amazing tax benefits because you can depreciate the structure, write off or depreciate most expenses on rentals, including interest payments. So many advantages to rentals. That's why I love them so much. They've been amazing to me. I have purchased 17 rentals, sold a couple in the last year because there are properties I didn't like and our market's gone crazy in Colorado. And thanks to selling those rentals, refinancing a couple of other ones, I've pretty much bought my 15 rentals that I have now without any of my own money. I've taken it all back out with refinancing or selling the couple I have, and they make me about $6,000 a month. Plus they increase my net worth by well over $1 million. So pretty amazing what they can do. But you've got to be careful with how you buy them. So I've got other videos on why cash flow is so important, buying below market value. Make sure you check those out. But like I said, today we're talking about how much money you need to buy a rental, what you need to plan for, expenses that come up, reserves, down payments, all of that. The first thing I want to talk about is buying as an investor. If you're going to buy as an investor, you're not going to be living in the property. You're going to rent it out as soon as you have it. You're going to have to get a different type of loan than if you're going to live in a property. So right now, in today's financing world, things are a lot stricter than they were a few years ago. Well, 10 years ago now, before the housing crisis. You're going to have to put down 20% in almost every situation as an investor, doing a regular loan. So for this video, we're going to use a $100,000 purchase price as an example for what you would need is for a rental property. If you're putting 20% down, obviously that's $20,000. So that is just your down payment you would need. And many banks will finance rentals, Wells Fargo, Chase, big banks will finance them, small banks will finance them up until you have 4 properties. Once you have 4 properties, 4 mortgages, then banks like the Chase, the Wells Fargo, the Bank of America, the big banks will say you can't get any more loans. But there are local banks that will lend to you. There are even some national rental property lenders who will lend to you and don't care how many mortgages you have, they'll keep giving you loans. So just remember that for the future. Once you have 4, you're not stuck, you just need to find a different lender. But back to what you need. So you've got 20% down. Just about every bank's going to require that. And in fact, some banks, after you get to 4 mortgages, will require 25% down. That's when you kind of want to start looking around, maybe finding some other lenders besides the big banks. But besides that 20% down, you're going to have other expenses as well. So when you buy a property, you're probably going to want to do a home inspection, which could be $300, $400, sometimes less, depending on how big the house is, where you're located. The bank will probably require an appraisal. They'll have an origination fee. They'll have recording fees, title fees. There'll be quite a few closing costs when you get a loan. So usually count on about 3% of the purchase price to go towards closing costs. And that is separate from your down payment. So if you're buying that $100,000 property, you'd have your $20,000 down payment plus $3,000 in closing costs. And part of those closing costs will go towards paying your home insurance for the first year and paying taxes, property taxes for the first year. So if you're in an area that has a really high property taxes, you might have even more closing costs than that. Luckily, I'm in Colorado where we have really low property taxes. That's one reason why I love my rentals here as well. Now, you can ask the seller to pay closing costs for you in some situations. Many owner-occupants do it. Some investors do it as well, where let's say you're buying that house for $100,000. You need $3,000 for the closing costs. You can say, hey, maybe I'll offer you $103,000 and ask the seller to pay $3,000 of your closing costs. That would mean you're paying a little more for the house, but you're still only needing to bring that $20,000 to closing. You don't have to bring the $23,000 if you were paying the closing costs yourself. Maybe you can even offer $100,000 and ask the seller to pay your closing costs, negotiate a little bit, bring the price down. But that's one option to get your cash needed, lower than if you're paying all the costs yourself. Now, something else to consider when you're buying a rental property is you don't want to have the absolute bare minimum available to buy it. So if you're going to buy a rental for $100,000, you probably want to make sure you have more than $20,000 or $23,000 in the bank. And in fact, the bank is going to require you to have more than $20,000 or $23,000. They're most likely going to want you to have at least 6 months of reserves for all mortgages you have. So that means any mortgage you have in your name, including your personal residence, they want to make sure you have enough cash to cover 6 months of mortgage payments for those properties. So if you have one property you're paying $1,000 a month on for your mortgage, the bank would want to see $6,000 in reserves for that property. And that is on top of the down payment you're paying. That isn't, it's not included in that $20,000. You would need that in addition to it. If you have, another property where you're paying $1,000 a month as a mortgage, you need, $12,000 in extra cash to cover those mortgages on top of the down payment. So let's assume you have a personal residence you're paying $1,000 a month on. You're buying your first rental property. You would need the $20,000 plus another $6,000 in reserves for the personal property you have, and you need reserves for the property you're buying. So maybe your payment's going to be $600 a month on the new property. That means you'd need that extra $3,600, the 6 months times $600 for your mortgage payment, in addition to the $6,000 in your personal house. So you'd need about $30,000 bare minimum to buy that property as an investor, and that's assuming you're getting the seller to pay your closing costs for you. Now, is that fair? I actually think it's very fair, because if you're buying a rental property, you're going to have vacancies, you're going to have some repairs, you're going to have some hiccups along the way. You don't want to have the absolute bare minimum amount and all your money invested in that one property. You want to have reserves. You want to have some cash available in case the house is vacant. In case you have to go through an eviction, which is never fun, but it happens. In case you need to replace a roof or something, of a furnace. There's all types of things that come up. You need to have that extra cash available so that you don't run into a disaster where you lose a tenant, you've got to pay your mortgage, and you have no money. So I think $30,000 is not ridiculous to have in the bank when you're buying a $100,000 property. Now we'll talk about some other ways to get into a property for less later in this video, but this is if you're buying as a straight investor, 20% down loan. And something else to consider, I love to buy my properties below market value. I love an awesome deal. I love building in equity as soon as I buy it. Makes it easier to refinance later on, makes me look better to the bank, makes the cash flow higher because I'm getting a great deal on the house. But a lot of times I have to make repairs on those properties when they're great deals. So if you've got to make repairs, if you want to buy a house that needs work, you've got to add that to your budget too. If the house needs 10,000 repairs, 15,000 repairs, you may need that cash available. Also, you need $40,000, $45,000 to buy that rental property if you're buying properties that need work. As you can see, it can add up pretty quickly to how much money you need. The nice thing is, you don't always have to have that money tied up into the property. Eventually, if you refinance down the road, you can take some of it out, maybe all of it, and still have a great rental property and get your cash back. But you're still going to need that cash when you're first buying the property. All right, so I know it can be a little bit shocking to some people that know how much money you have to have for a rental. What are some ways to reduce that amount? Well, the first thing I'm going to talk about, which is probably difficult for some people, is buying as an owner-occupant. Now, it takes some sacrifice. I'm not saying you buy as an owner-occupant and rent it out right away. That would be loan fraud. I'm saying you buy as an owner-occupant, live in the property a year or whatever the loan requirements are, and then turn it into a rental after you've lived there for whatever the required amount of time is. And when you buy as an owner-occupant, there's a number of advantages. And one of the biggest one is you can put a much lower down payment down on the property. If you do an FHA loan, you can put 3.5% down. Conventional can go as low as 3% down if you have the right income requirements. If you make too much money, you're probably going to put 5% down with a conventional loan. And putting that less money down, now you're putting $3,500 or $5,000 down instead of a $20,000 down payment. With FHA and conventional, you can also ask the seller to pay your closing costs for you, just like you could as an investor. So you'll just have that down payment. You won't have the closing costs added onto it either. And something else that's available, like I said, I'm in Colorado. We have some amazing down payment assistance programs. Most states have them too, where you can get state grants, state programs to help you pay your down payment. So there are some cases where we have helped people buy houses for $1,000 down, out of pocket. Really cool programs. So there's ways to get into properties for much less money as an owner-occupant. Now, you still have to make sure the property would cash flow, have the right numbers after you buy it and rent it out, because you have mortgage insurance with most of those loans. Unless you're a veteran, you can qualify for VA, which is an awesome loan with no money down. If you can do that, take advantage of it. USDA has some rural development loans if you live in a smaller populated area with no money down and less mortgage insurance. But FHA conventional loans will most likely have mortgage insurance, which could add $100, even $200 a month to your payment. You need to figure that into your numbers when you're ready to move out, rent the property, make sure it's still worthwhile. Some other things to think about is if you're buying as an owner-occupant is repairs will be trickier. The loans will probably have more requirements, have to have a livable home, which means the heating has to work, the roof has to be functional, no broken windows, electrical in good shape, plumbing in good shape. And if the house isn't in that good of shape, it's going to be really hard to get that loan on it. But there is something called an FHA 203K loan, and you can finance repairs into that loan. It's really cool. You can buy a house for $100,000. If it needs $20,000 in work, actually get a loan for $120,000. As that work is done, the bank will pay your contractor who does the work from the loan. You finance those repairs into it. Really cool. Now, costs are a little more with that loan. You have to be careful with that. You need 2 appraisals in most cases. And it takes longer to get the loan. So it could take 60 days to get the loan, which can make it tough if you're in a really hot market where there's a lot of competition. Some sellers may not want to sell to someone who's using an FHA 203K. However, HUD homes are a great deal for many people. They don't care. They don't care if you're using an FHA 203K loan or cash, and they love owner-occupants. They give them priority. So if you're in that position where you need to use a 203K loan, you want to get a really good deal, you're buying as an owner-occupant, HUD homes are a great opportunity, something you should look into. All right, so there's the owner-occupant route. There's a straight investor route. As an owner-occupant, you can put as little as $1,000 down really to buy a house. If you're buying as a veteran, getting a VA loan, sometimes you can get your earnest money back and put absolutely nothing down. So there's some great opportunities out there. Again, if you can get a great deal, get when the cash flows, awesome. But be careful that you're not, over leveraging yourself, putting yourself in a bad position, putting that small amount of money down. There are some other options as well for investors to put less money down without being owner-occupants. I know that's what a lot of people are interested in because it's not always fun to move in a house. You want to make a rental If you have a family, they might not be too keen on that. So what else can you do? A hard money refinance is one option, or a private money refinance. So what you basically do is you buy a rental property with either a hard money loan or a private money loan. And what those are is private money is basically a loan from an individual, your parents, a business associate, your friend, family, whatever it is. They loan you the money to buy the property. Hard money loan is from a hard money lender who lends short-term loans, usually 1 year, maybe 2 years at the most, and they charge higher rates. You're going to probably be paying at least 10% interest, a couple origination points, but they will finance a higher amount for investors. So they may finance 85, 90% of the purchase price. And they may finance some of your repairs. So they may finance 85% of the purchase price, plus they'll finance 100% of your repairs. So instead of putting that $45,000 into a property with a straight 20% down loan as an investor, if you use hard money, maybe you're putting $15,000 into the property as your original down payment, and you're financing all the repairs and getting the seller to pay your other costs. You can put half the money into the property. But then you're asking, well, it's only a 1 year loan. What do I do after that point? Well, you refinance it into a regular loan. So Fannie Mae will let you refinance a property pretty much as soon as you buy it, as long as you're not taking cash out. So if you have that property, with a $105,000 loan, a $100,000 loan on it, you can refinance it into a conventional loan for that same amount, $100,000, $105,000, pay off the hard money lender, get into a 4 or 5% interest rate loan that's 30 years in amortization, much longer term, much safer. With that, there's some risk though. You have to make sure the house appraises for a high enough amount that your loan is 80% of the value. So you've got to be really careful with what you're doing when you use that option, but it is there. Great way to get into a property with less money down, but there's some risk there. You really have to know what you're doing. Be careful with the appraisal, the hard money, making sure you have other financing lined up. All right, and then finally we'll talk about the BRRRR method, which is a buy, rehab, rent, refinance. You can add repeat in there. And basically what that is you're using, again, either cash or, private money, some kind of short-term loan to buy a property. You repair it, and then you refinance it. So, depending on what type of loan you're using, if you're trying to get cash out, just pay off the whole property. You may have to wait 6 months after you buy it to refinance it, or even a year with some lenders. They could have what's called a seasoning period, which means the first 6 months after you buy a property, they will not give you a loan that's more than your purchase price or the appraised value, whichever is lower. So if you buy a house for $100,000 and in 2 months you want to refinance it and your appraisal comes in at $150,000, if there's a 6 month seasoning period, doesn't matter if that appraisal came in at $100,000, the bank is still going to base your loan amount off your $100,000 purchase price. That doesn't mean they'll loan $100,000. That means if they're loaning 80% loan to value, they'll be 80% of $100,000. So again, you've got to be careful with that. The seasoning period, make sure you're prepared for that. But if you can wait those 6 months, usually you can find a lender that'll have a 6 month seasoning period. You can make repairs, get a new appraisal, sometimes get more cash back than you actually have into the property, which is pretty cool. Again, make sure your property cash flows as a good rental, after you're refinancing it, after you get that long-term loan put in place. So, those are most of the options for getting into a rental property. There's some other ones. You can always use private money to try and pay for your down payment, friends, family, coworkers, business associates. You can try partnering, which is kind of difficult on rentals because usually it's a long-term investment. But if you're buying it by yourself, it should give you an idea of how much money you're going to need. The 20% down option, with the owner-occupant option. If you're trying to refinance it later, do short-term financing, there's that option as well to put less money into it. There's all types of different ways to invest in rental properties. And I've got lots more information on my blog, a lot of different articles. I'll link to some in the comment section down here below in this video. InvestForMore.com. Talk about it on my podcast as well, the Invest for More Real Estate podcast. And of course, I do have some coaching programs too, if anybody's interested. We do some conference calls and different things and talk about all these financing options, and have email coaching as well with some students. So thanks for watching. Hopefully this was helpful. If you have any questions, respond below. I will always respond to people and try and do it as quickly as I can. And you can email me too, mark@investformore.com. And hope you have a great day.